The 20s, which saw remarkable rise in things like home ownership, which saw the quadrupling of savings accounts in terms of their value from the previous decade, which saw things like the automobile go from around a couple million at the end of the 19 teens to almost 26.5 million by 1929, was an incredible time of boom, an incredibly prosperous period. It was a period also where most Americans owned stock. In fact, it's estimated that somewhere around 29 to 30 million Americans had invested at least part of their wealth into the stock market. And there were some 1 million Americans who were actively involved in regular investment, in regular speculation of the stock market. All this at a time when the country had about 120 million people total. It was also, curiously, a time when companies looked to the stock market as a way to really inflate their actual value. Often that was not reflective of their value in terms of what they actually possessed or whether or not they actually made a revenue. In other words, Paul Johnson points out that companies would often take out bank loans at around 9 to 10%, and they would use those loans to buy new assets, which would often make their stock go up and give them a profit of around 1 to 2%. In other words, it didn't necessarily make long-term economic sense, but it made short-term economic sense.